Welcome back to the What You're More podcast. I'm your host, Quinton Harris, and we are back for part 2 of the lending update with my co-host, Daniel Halvorsen. Thanks for joining us again on the second episode.
It's like I never left.
It is like you really have a choice, right? The door didn't even open. So we're just going back to back on this one, episode 151. But hey, if you just listened to the last episode, we broke down quite a few things as far as paying discount points, down payment assistance, and then homeowners appreciation and what we saw from CoreLogic through 2023 and a forecast in 2024. This part, we're going to break down rates. We're going to break down a little bit of the CPI index, and we're also going to break down the Federal Reserve and maybe the next move. And it feels like we're getting closer every single meeting to that moment. And we're going to talk about that moment. And I mean, I know we sound like a broken record, but at some point things are about to happen. And there's a lot of other ripple effects if we start to see some sort of pullback from this restrictive territory. What does that mean? And we're going to explore what that means for you as a buyer, for you as a seller, and all real estate agents and lenders included. So enough with all that talk. Let's jump right into it here. Mortgage rates, inflation. You say inflation is a buzzkill to mortgage rates. Go ahead and kick it off, Daniel. Kind of talk to us a little bit about that.
Well, the problem with recording this after the lending update has been posted is that things happen after that.
Well, hey, fair enough. Good friend of ours, Barry Habib, says anytime you do a forecast, you have to release it within 48 hours or it's already irrelevant.
Might as well record these as I'm typing this. But so basically the synopsis here is that the data, the inflation data for the month of February that came out in March, a little bit hotter than expected, which is not good for mortgage rates. So that did not work in our favor with respect to what mortgage rates did in the earlier part of March. Mm-hmm. Now, as we're talking, last Tuesday and Wednesday, the Fed met. At the conclusion of that, Fed Chairman Powell came out and gave his song and dance press conference, right? And they didn't cut rates, which nobody thought they would, but they held firm in there. We're going to cut rates 3 times this year, which is something that I think as the inflation data came in hotter, the market started to say, okay, well, what's going to happen now? So the fact that they came out and said, we're going to cut rates 3 times, the market's like that. And that was a good thing for interest rates and kind of put us back to even in a way. So that helped a little bit, but the inflation data that came out in March for February didn't necessarily help us with respect to
prior to the
rates.
meeting didn't really help. But if you're a lender and you've been sitting on the edge of your seat, like, man, it is going to happen. We're going to get a rate cut. Rates are coming back. This had the outcome. That couldn't have been any better besides a rate cut. This had the propensity of a meeting to where it could have gone wrong real quick, real bad. Like, for example, if he'd have come out and said, we're forecasting the dot plot map would have said 2 rate cuts instead of 3, all hell would have broke loose in that bond market. Yep. We could have potentially be looking back at those upper 7s. So if you're a mortgage lender, hey, grab your beer, grab your drink, pop that can, enjoy it, because this could have gotten bad. This could have been really bad, and it wasn't. Yep. And I just, I want to emphasize this is not a moral victory, but this was a big win.
Absolutely. And I think that, in my opinion, what I am starting to feel is that the Feds want the 10-year to be trading in a certain range.
Correct.
Until they determine when they want to cut rates. And they have become more proficient at talking to the markets in a way to achieve that outcome.
Right.
They don't want to see another spike in the 10-year yield, as that would impact the economy as a whole. And they're going to say, if they're not going to cut rates, they're going to still say nice things to keep things trading in a certain range, right? They don't want the bond market to get away from them. I don't think they care that much about mortgage rates, but they're more concerned with what's going to happen with the 10-year and how that impacts debt and their ability to finance the debt, the government's ability to finance the debt. So when people ask me, hey, what's going to happen with interest rates? At this point, my answer is we're going to be in this same range we've been in for the last 12 months outside of probably springtime of last year where we saw rates dip pretty nicely. But we're going to be in this range until we get a rate cut.
And that's the question. When is that going to happen? But before we get to that, there's some things. Okay, so I think for the first time in 18 months, Powell signaled some significant signs that tell me the rate cut's coming. And it tells me it's coming in the April 30th, May 1st meeting. Number one was he said, we don't need the job market to get weaker in order to have inflation go down. He finally said that. He hadn't said that. And he said, and we're watching the initial claims, initial jobless claims. He finally said he finally acknowledged like that was a leading indicator for them.
Which we've known for quite some time, right?
Which we have been preaching for quite some time, right? But he said, we want to keep. The other thing was, so that was number one, right? And inflation's been coming down, right? Job market has weakened but not deteriorated. Okay, check. That was number one. Number two was he said, we'd like to keep the balance sheet to the growth rate of GDP, right? To a specific growth rate. So that growth rate is typically 23%. Well, they're at a $6.9 trillion balance sheet right now. And the reason I bring that up is quantitative tightening, which they've been running off the balance sheet. Started at 9, now we're at 6.9. They've been running it off. He said we'd like to keep it at the growth rate, a specific growth rate of GDP, which is 23%. Well, if you take 23% of the GDP right now, that's $6.1 trillion. We're very close to that number. So that's signal number two.
Yep.
And then the final one for me was that when Powell came out and talked about he fully anticipated PCE, core PCE to get to 2%, and that a big portion of what he thought would cause that were rents deteriorating because they finally took a look at the lagging information coming in on the owner's equivalent of rent, and then what you're seeing on the Zillow rent rolls and the other real-time rents that are coming in, that they're very low. Their numbers are down compared to what the PCE ratings bring it in at. So I think that was the third thing. Check. I think there's three major signs there to let me know, okay, they're heavily considering this rate cut on May 1st, not so much in June like everyone thought.
Yeah, well, we'll see if you're right. Call your shot, right?
That's
and
right.
And we'll put a bow on this at the end with a couple of other thoughts as it pertains to rate cuts. But just kind of recap. So in March, we got February's consumer price index inflation reading, and the headline number increased from 3.1 to 3.2. So really no change there, right? Mm-hmm. The core rate went down from 3.9 to 3.8%, which you would think normally is good news, but the markets were expecting lower inflation on the headline number, and they were expecting the core to come down another 1/10 of a point. So even though they went down, inflation was hotter than expected. Markets don't like that. Maybe it pushes the timeline out for rate cuts, right?
Yeah,
and we're starting to see that the core inflation on the CPI is pretty sticky, right?
Right.
And some of that is with the logic behind how they're calculating owner's equivalent rent, which is above and beyond the heaviest weighted item that contributes to core inflation.
Correct.
And we could talk about that, as much as we wanted to, but part of why that's not coming down is in my opinion, some ways that's being calculated is impacting that a little bit. But on the inflation side of things, so the other component, the consumer price index, is what are prices doing for consumers, right? The flip side of that is producer price index, which is producer inflation, which is how much are prices increasing for the companies that are making the goods that then they have to sell to consumers, right? And that number came in. Now, granted, it was very low already. The producer price inflation increased from just 1% to 1.6%, which is still a relatively low number, but that's a pretty significant increase.
It's a 50% plus increase.
That's a big number to see that increase in one month. And the logic behind that, obviously, is if the price of making the goods goes up, then presumably the price of buying the end good could go up as well.
Got to pass it along somehow.
So that wasn't great news. And then as we talk, we'll get the PCE reading at the end of this week on Friday. But the one that came out at the end of February, once again, good news for the most part. The headline number fell to 2.4%. The core number came down from 2.9 to 2.8. So, and this is the Fed's preferred measure of inflation, PCE.
Right. This is the one they're keeping the eye on.
Which just so happens to be, over the last probably 12 plus months, it's been lower than CPI. And it's calculated differently. So there's things that are weighted in there differently. So they've turned to this as their preferred measure. They think it's more indicative of real-time inflation, evidently, which is interesting because even though those numbers go down, the markets really only seem to care about CPI. So good news on PCE doesn't really help us a whole lot on interest rates, whereas when the consumer price index comes out, that appears to be really what the markets are reacting to.
Right.
So logic behind that, I don't know what the logic is behind that, but we did get good news on PCE, which I don't think we're going to get any significant help from PCE that's going to come out this Friday as we're recording.
Well, let's hope this Friday's a Good Friday, right? We hope Good Friday is Good Friday, and that we get some PCE data coming there. And I mean, listen, you look at the Cleveland Federal Reserve; they flash out what they think the core reading is going to be. There's always these anticipated numbers, and so to your point, when the markets like and don't like things, what we're talking about is all these numbers that are anticipated or forecasted by the Cleveland Federal Reserve. People expect that to be the kind of the barrier, the benchmark, if you may. And when it doesn't come in at that, and if it comes in higher, that's bad for the markets. They react badly. If it comes in lower, it's almost like, we were kind of expecting that anyways, right? So it's a reaction that we it seems to only react when it's bad.
Yep.
We don't get this huge windfall like we've been anticipating. But if it keeps coming in lower, the closer we get to 2, I think we get closer to that part of that dual mandate.
Absolutely. Well, and the good news is the markets are closed on Friday. So if we get bad news, we don't have to deal with it until Monday.
We got a weekend to let this up. That's right. We'll see you on Monday, right?
Yeah, that's right. So, but the other component we've talked about, obviously more and more of recent, is the job data. Mm-hmm. And as usual, the Bureau of Labor Statistics, their headline job creation number came in way hotter than expected. I don't have it in front of me, but it came in way hotter than expected. What helped us a little bit on the unemployment side of things was the unemployment rate actually went up from 3.7 to 3.9%. And if you're wondering how job creations were way higher, but the unemployment rate went up, the answer is simple. The business, they survey businesses to get job creations.
Correct.
Survey households to get the unemployment rate. So you basically get 2 different sets of data. What are businesses saying in terms of if they hired or not? Mm-hmm. And then what are households saying in terms of if they have a job or not? Right.
That's correct.
Right?
That's right.
So basically on the household survey, the unemployment rate went up from 3.7 to 3.9%. The household survey showed 184,000 job losses. So households were saying, hey, I don't know what's going on with what these businesses are saying, but we lost our jobs, right?
Right.
And the unemployment rate is now 0.5% above the low of 3.4, which generally a recession signal when you start to see unemployment ticking up like that.
Correct. Which is what the Fed is also the 19 voting members. This is their fear factor, is a recession.
Correct.
Right. That's what they're worried about.
Well, and I think that to kind of put a bow on my thoughts on when we might get that rate cut and why April 30th, May 1 would be a really good time to do it, despite the fact that we're already overly restrictive with monetary policy. That would be reason 1 to cut rates. Reason 2 is if you look at what it would take to get the inflation from where it is now to 2%, you basically have to have non-existent inflation.
Like 0.16 for 12 months.
Correct. You have to have basically non-existent inflation for a long period of time to go from whatever metric you're using, to go from 2.8 to 2%.
Correct.
It's a huge number. And on the CPI, the number is way higher, right? So it's going to take a lot longer. So if they're looking at this dual mandate and saying, hey, what are we going to do? Well, if they wait until they get to 2% inflation to cut rates, it's probably not going to be a good situation for the economy as a whole. Mm-hmm. So I think that the path to the soft landing, which is lower inflation without a job loss recession, right, or a recession in general, the path to that is, well, we got to cut rates in advance of the job market becoming a very, very bad situation.
Correct.
Right? So I think that's the path where you could see a rate cut in end of April, early May, or maybe just sooner than later in general. Is they're looking at this and saying, okay, we're seeing weakness in the job market and we don't want this to get away from us. And if we're somewhere in the 2s on core PCE, we can afford to cut rates a little bit to hopefully keep the job market relatively strong, right? It's not a weak labor market that we've had. We've said that a number of times. We don't have a weak labor market, but it is a weakening labor market. It's
showing signs of weakening. And the other thing is this, when you take a look at everything you just kind of put in perspective there, the PCE already has a 2 handle on it. We're there.
Correct.
Like we're there. You've already achieved it. Yeah, are we at 2 flat? No, but we already got it in the 2s, and that's what you wanted. And they acknowledged that in the last meeting here. The other thing is this with unemployment. It's at 3.9 right now, right? Yep. So the Federal Reserve, the 19 voting members, I believe 9 of them said they're very concerned with 3.8% unemployment. They fear that that's signaling a potential recession, and we should start lowering rates at 3.8. The other 11 say 4.1.
Yep.
So that's a total of that's more than 19. So it's 7, it's 8. I can't count. 8 and 11, right? So that's 19. So they're already there. They're at 3.9. So you've already got a little bit of half of the voting members going, they're already signaling, hey, listen, this is an issue. We think we should pull back, right? So, I mean, I think that I think that's the 4th check box I was talking about there. It signals that rate cut's imminent and coming. Into your point, I think it is going to be April 30th, May 1st. Because of here's the thing. It's like, think about a roller coaster. When you get to the tip top, once you start going down, you can't make it stop. It's going to keep going. So what they don't want is that unemployment rate to get up there to where it's too high and you can't pull it back because you've been restricted for so long, right?
Correct. Well,
and there's the problem.
That's where it starts to run away, And the dual mandate is price stability. And full employment. And
Correct.
price stability is not defined as 2% inflation. That's a number that was said one time and now has become the holy grail. So the Fed's mandate is not we have to have 2% inflation.
It's
right?
not.
Price
No.
stability is their
That's correct.
goal. So, but I think if you were to survey really anybody that's alive, they would say that if you were picking between a little bit more inflation or not having a job, they're probably going to choose, well, I'd rather pay a little bit more and have a job, right? So
Right.
if you're a Fed member weighing which one of these things is more important, well, maximum employment is more important than price stability. Now, they're both important, but if you're going to pick which one's more important than the other, I think it's probably pretty obvious that having a stable labor market is probably something you would give in exchange for maybe a little bit more than 2% inflation.
Right. And there seems to be, you take a look, there seems to be two types of sides to the Federal Reserve right now. There's a group that wants to wait to cut rates because they want inflation to come down. I think it's still too hot, and I think the economy's okay. Like, it's not like, thriving, but it's in good shape. And there's another group of the Fed that's basically saying, hey, listen, we need to cut rates sooner than later, basically because unemployment's rising. And the risk of sending this United States into a recession because of what we just talked about, that's a real thing. And between those two groups, that second one is outweighing in the count more than that first one, meaning you got more voting members that feel that way about sending the economy to a recession because of an issue basically being restrictive and the unemployment loss. So that's the fifth and final signal.
If you're a Fed voting member, you don't want to be responsible for what a lot of people are going to think, keeping policy too restrictive and pulling the economy into a recession
Right.
where maybe it could have been avoided, right? So you don't want your name attached to that. So
Right.
let's hope that we can start to see these rate cuts.
And this is the chart. Charlie will put this in our YouTube channel, but that's the chart that I was talking about right there, where it showed these voting members and where they're at on there as far as that unemployment rate.
Yep.
And we'll have that in our YouTube channel at What's Your One More there. We'll throw that in there. My friends over at MBS Highway put that together, but it kind of represents that fourth checkbox I was talking about there. And, hey, listen, are we going to be able to sit back on the 2nd of May, or I guess it would be the late afternoon of 1st of May, we got a rate cut. Here's one thing I do want to put in perspective. If we get one, it's going to be a quarter.
Yep.
It's not going to be a half. And if we get 3 throughout the year, that's going to be a quarter each one of them. They are going to step this down ever so slowly, because the worst thing they could do is have a rate cut and then inflation get out of control again. And then, hey, here we are back to square. So they are going to ease this thing down. But what does that mean for mortgage lenders? What does that mean for buyers? What does that mean for sellers and real estate agents? Well, I'll give you my quick take and then you come into it here. But I think what that means is that we've been talking about this 10-year being in this consolidated phase right now. Can that push the 10-year down just enough to get it in that upper 3 range, right? Can we get into that 3.8 range, that elusive 3.78 range? Once we do that, guys, hey, man, we're back in the low 6s, probably potentially even upper 5s. There's a lot of volatility in that market right now, that just any type of signal of getting back to a less restrictive territory is going to be a windfall for mortgage rates and buyers. Buyers, you're going to get that affordability is going to be created overnight, probably then again absorbed overnight by the sellers raising prices.
Right.
But there will be a window for you to take advantage of this. And if you're a real estate agent, if you're a lender, hey, this is the spring season. It starts officially on April 30th, May 1st. If they lower those rates, you can bet everywhere around the country it's over with.
Well, I think the other thing is, I think that the first rate cut will do a lot for mortgage rates, mainly because of euphoria.
Right.
But the other thing we've talked about in the past is the spread between the 10-year yield and mortgage rates. And historically, that spread's about 175 basis points, meaning if the 10-year is at 4%, which is not far off from where we're at, mortgage rates historically would be about 5 3/4. Over the last 18 to 24 months now, maybe not quite 24, but that spread has been anywhere from 275 to 300 basis points, meaning if the 10-year was at 4, you're somewhere between 6.75 and 7 on mortgage rates.
Which is absurd.
But I think that if you get a rate cut, then some of that, and the reason that spread is what it is because the uncertainty of what's going to happen with interest rates. So I think that if you start to see, if you get a rate cut and it becomes apparent that we could be in a cycle of rate cuts, that spread could evaporate. So without the 10-year necessarily falling off a cliff, you could see mortgage rates get better than the 25 basis point cut in the federal funds rate.
Right.
So you could get an overcorrection that would finally help us in the markets, which is why I think that first rate cut is so important to being able to accurately say what's going to happen with interest rates.
Yeah, and to your point, there's room to be given in that 10-year. And for our audience, hey, if the Fed cuts rates a quarter, that doesn't mean on the lending side it's being cut a quarter. They're not dollar for dollar, point for point. All that means is that they are reducing the Fed funds overnight rate, the effective Fed funds rate. But what that does is that sends signals to the bond market as well as to the equities market that, hey, listen, we're getting away from restrictive territory, which is kind of like this injection of energy and a windfall to people going, oh, okay, this is great. And so what happens is the yields on the 10 start to come down. Right. And as they come down, mortgage rates improve. So something to keep in mind here, to Daniel's point, is that a quarter over there could send that signal of stability that we've been looking for the last 24 months. This could be it. We could be going, the cycle of this madness of restrictive territory is over with.
Correct.
And that is really important. So it could be it very easily could be that cliff we've been talking about for interest rates, because there's so much room to be had on that side. So if the investors on that side get any wind or any inclination of stability, yeah, that could be a really big win. That quarter could be a euphoria, as you said. It could be a big deal for the mortgage side and for buyers.
Well, one last thing. So for the people out there that have a variable rate HELOC, those Fed rate cuts will immediately translate to lower interest rates on your home equity loans.
Fantastic.
So just as an aside, it's not a direct correlation with mortgage rates by any means. But a lot of times home equity loans are attached to the prime rate. And if that federal funds rate is cut by a quarter, that interest rate will be 0.25% lower the next month.
Yeah.
So there is some immediate impact for those that have HELOCs. And we've talked to some people that have home equity loans and those rates have gone up and they're not happy about it. So there is an instant win for interest rates as well on home equity loans.
Yeah, credit cards included, right?
Correct.
All those variable rates that are tied to an index, you're immediately impacted by that instantaneously, along with money markets, right? So there's a lot of impact on those sides where things happen. So definitely could be really quick and could be impactful buyers, sellers, and current homeowners with home equity lines and those with credit cards as well. So guys, if you like what you're hearing, please 5-star review this podcast. We're on every platform you listen to your podcast on, and then subscribe to our YouTube channel at What's Your One More. We appreciate all the comments and feedbacks you leave on there. It helps and inspires us for future episodes. Daniel, as always, thank you for being on this show. Thanks for the insight. Thanks for all the great value you bring to our listeners. Really appreciate you being on here today.
Absolutely, man. Happy to do it. Looking forward to the next one.
Absolutely, guys. Till the next episode, we'll catch you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into